You've got a mortgage or you're about to get one. So you're probably realizing it's so confusing to understand your mortgage, right? Fixed, floating, offset, repayments, refixes, refinances. It's a lot to wrap your head around. And if you've ever wondered, am I even managing this the right way? Or how can I manage it even smarter? This video will clear that up for you. By the end, you'll understand exactly how a New Zealand mortgage works and how to manage it smarter, including one simple shift that can save you thousands over time. Stay till the end because I'm also sharing how I structured my own mortgage to turn a 30-year mortgage into a 7-year story. The problem isn't just that homes are expensive, it's that our mortgages are massive. People take on 30-year loans later and later in life thinking it's the safe or the normal option. But here's the truth. The 30-year mortgage isn't designed for you. It's designed for the bank. By the end of this video, you'll understand how to take back control of your mortgage and your money. Now think of a mortgage like baking a cake. Everyone gets the same ingredients: bank products, your structure, your repayment strategy, and some options on how you manage it. But most people just throw all of those things together and just hope for the best. The difference between being mortgage free in 30 years or 10 isn't about getting better ingredients, right? Managing your mortgage smarter is about following the right recipe. And that recipe starts with understanding what's inside your mortgage. You have two things: principal and interest. The interest you pay depends on how quickly you reduce your principal, right? So pay it down faster and you save thousands of dollars. Let's break down those 4 ingredients so you can see where your control really is. Ingredient number 1, bank products. Every bank offers slightly different loan products, whether they're fixed loans, floating loans, offset loans, revolving credits, and each can be used strategically. For example, a floating loan lets you make lump sum repayments anytime, while a fixed rate locks you in, but gives you rate security, right? And you know what your repayment's going to be. Offset and revolving credit loans are the real game changers though. They use the money you already have, your savings and income, to reduce the daily interest that you pay. That's how you can literally cut interest without earning $1 more. So if you want to manage your mortgage smarter, start by learning how these 2 bank products work. They're the key to playing the bank's game smarter. So ingredient number 2, mortgage structure. Your mortgage structure decides how those products work together, how many loans that you have, how they're split, and how long each is fixed, right? That's your structure. It's just like baking. You mix the dry ingredients first, the wet ingredients second, and then combine them to get the perfect texture. The same applies here. So your structure is everything in the right order. So you have smooth, predictable results. Here's something most people don't know. You can have as many separate loans as you want under one mortgage. You can have 3, 4, 5, however many you want, however many individual loans you want, and that can sit against one single property. That's how you can create a flexible mix of fixed, floating, and offset portions that match your financial goals. So ingredient number 3 is your repayment strategy. Every mortgage has 2 parts, principal and interest. So the bank's plan, though, gets their interest first, and your freedom comes later, if at all, right? If you only ever pay the minimum repayment, you'll be stuck for 30 years or more. But here's where you take back control by making principal-only repayments. These are repayments that go directly towards reducing what you owe, the amount that you actually owe your principal. And the smaller your principal, the less interest you pay. There are 3 main ways to make principal-only repayments. Number 1, increase your minimum repayment. That speeds up the bank schedule because anything extra above the minimum goes straight towards the principal. Number 2 is to make regular lump sum payments. You can add extra to your mortgage with your surplus income up to the bank's annual limit for lump sum payments. And the third is to make one large annual lump sum payment that goes straight onto your principal every year and takes a huge bite out of your balance. Each of these strategies directly attacks your principal, and that is the key. Whichever one you use, you just at least need to be using one. Now, the faster you reduce it, the less you pay in interest, and the sooner you reach financial freedom. So instead of following the bank's 30-year plan, create your own plan that pays the principal first. Now, ingredient number 4 is automation. This is a secret ingredient. Not everyone is using automation as an ingredient for their mortgage, right? It basically makes your recipe foolproof. It basically makes your mortgage recipe foolproof. Automation is how we teach our clients inside of our signature Freedom Blueprint system to save and pay their mortgage with ease. It's the part of the structure that keeps their money flowing automatically toward freedom. They create a spending plan that shows how much they can save each year and then set up accounts that move that money without even thinking about it. Instead of waiting to see what's left over, automation makes sure your savings and your mortgage payments happen first. Pain-free and predictable. Sounds great, right? It's the system that keeps everything running smoothly, even when life gets busy. All right, you stayed with me, so here's the bonus tip I promised. This is how I structured my own mortgage to pay off a 30-year loan in 7 years. I used a mix of revolving credit and offset accounts. My revolving credit gave me flexibility, and it acts like a giant overdraft that reduces interest on every dollar you leave in there. Offset accounts linked our savings and income directly to the mortgage, so every cent worked for us, not the bank. When you understand how these 2 tools work together, that's when a 30-year plan turns into a 7-year story. I also used splitting up my mortgage into several loans. So at any given time, we at least had 3 different loans. That meant that we spread the risk. When interest rates go up, we're not having to have our entire mortgage go up at one time. So now you know what most Kiwis don't. Your mortgage isn't a life sentence. It's a system you can control. Remember, the bank has a plan for your money. It's time that you had one too.